And a very warm welcome to Headwinds and Tailwinds, Navigating Indian Financial Markets, brought to you by Moneycontrol in partnership with Refinitiv. The topic for discussion today is insights and challenges of forex trading. Well, we are looking to talk more about technology and innovation and get greater insights to traders, banks, and other institutions on forex liquidity, transactional costs, and of course, try and streamline operations to add value to the existing customers. All of that is going to be the part of conversation today. Joining us for the conversation is Mr. Sankara Sambas Sivan. He's Proposition Sales Manager, Refinitiv and LSEG Business. Joining us also on the conversation is Brajesh Chalil. He's Head of Treasury Market and Sales at Axis Bank. Also joining us on this webinar is Mr. Bhaskar Pandya. He's Senior Vice President, Treasury and Advisory Group at HDFC. Gentlemen, hi, thank you so much for joining us. And quite a conversation is what we've seen in last 1 year on all financial markets, the easy money, and the currency markets have been quite on a tear as well. This one is to you, Sankara. First of all, we have seen very choppy moves come in for the Indian rupee itself. We saw 6-month lows, and then there has been some appreciation in the last few sessions. Overall, what's your sense on how are the currency markets dealing with the current inflow or, the kind of conversations that we have, whether it has been about Fed tapering, the easy money, and clearly the kind of opening up that we've seen in various economies?
Right. Thank you. So, to me, if I look at it from a perspective of the near term, which is the next 2 or 3 months, I think the biggest topic in everybody's mind has been Fed tapering. There's been on and off conversations. Obviously, Fed has been talking about it for quite a while now, but there have been a lot of conversations in the recent past and a lot of indications from Fed on that sense. So I would expect that would have a significant bearing on Indian rupee in the near term. And with inflation, I think it's been a bit transient. We saw the inflation numbers at about, the WPI was as high as more than 10% in the recent past in May, and it's come down a bit. And CPI, on the other hand, has also come down from 6.5 to 4.5 recently. So it seems to be transient. So I think for me, the biggest impact would still continue to be the Fed tapering, with supply chain constraints around inflation slowly and steadily ironing out over a period of time. I think we'll probably see a lot of pressure on rupee on the depreciating side.
I will come to you on those numbers as well. On what sense do you really have on how much can we see the rupee depreciate? But Brajesh, that's the same question to you too. There has been a lot of volatility across financial markets, and currency is not too far away from that. And as Sankara was saying, that yes, inflation a part of it, but majorly Fed tapering. Would you also stack it in the same way, rank these fundamentals the same way?
So first of all, hi Manisha, and hi to your viewers as well. So I think what Sankara said is pretty accurate, except for the fact that I think we've all been hearing a lot of central banks say that inflation is transient, and but we've been saying that for a while. So I think if we step back and look at that, so it's in line, right? So we have inflation, which is probably caused by supply side issues, as we're all aware. So supply side issues, inflation, and then obviously we're talking about tapering now. So on the supply side, those issues, whether it is coal or whether it is chips, those issues have actually stayed longer than we would have liked. If you look at inflation, it's almost 5.5% in the US. UK has it as almost 3.5%. In fact, and it's causing various central banks to do different things. So you actually might see the UK start hiking, and the funny part is they're actually going to hike possibly before they taper or ease. So it's kind of contradictory. So where does that leave the US and then finally India? So so the market's take is, and to be fair, the Fed doesn't like to surprise, and the Fed has said that we're going to be moving towards tapering, and we should be done by mid-year next year. So we reckon that out of the 120 odd billion that's been done every month, to get to almost zero by mid next year, you'd see some tapering to the tune of about 15 to 18 billion. And possibly after that, the market's factoring a couple of rate hikes. But again, this is all pristine. This is markets assuming everything goes through smoothly. I'm not so sure about that. From an India perspective, yes, most of this is priced in. But I do agree with Sankara that I think Rupee has, definitely some risks coming its way, whether it's oil or the shock of tapering. But the risks are fairly real to Rupee on the to moving on the higher side.
Mr. Pandya, what is your sense? How do you see the US Fed tapering expected to impact the Indian rupee going forward, where we have seen a huge amount of volatility in the recent few months?
So in 2013, when Fed started talking about tapering, there was a tsunami which came into the world markets and which actually swept away all the all the currencies, including INR. INR at that point of time, if I remember correctly, lost almost 15 to 20% because as a country we were not at the most prepared stage, I should say, because of our current account deficit, because of our higher inflation, so on and so forth. And the most important point is that we didn't have the kind of reserves that we boast of today. So our reserves were pretty low at that point of time, and as a result, what happened, the tapering, what we call taper tantrum, actually affected most of the developing nations, and mostly India, Indonesia, South Africa, or a couple of more countries which were which saw the most depreciation at that point of time. Probably that is not going to happen if something has to happen now, because structurally we have become a little different.
So, yeah, Brijesh, taking in from what you said, inflation is one part of it, the rising crude oil price is the other. But how would you look at the last 8 to 12 months, where we've seen almost every asset class run up, including Indian rupee as well? The declines really came in very, very recently. How would you look at the way various asset classes are doing, and how would you put currency there?
So, again, it all stems from the fact that one is we have to take cognizance of a couple of things. The first is, we're out of a pandemic, and the solution that the markets gave to this pandemic is a ton of money. So there's almost 11 to 12 trillion dollars of quantitative easing money that's lying out there, fiscal stimulus, so to speak, and all of that has obviously given a rush. So, which is why you've seen most liquid assets, whether it is stock markets, whether it is private equity valuation, the number of unicorns we're seeing. I'm not saying there is no good story here, but the point is, I think we all have to be cognizant that, there is a ton of, there's a kind of wall of water that has lifted all asset classes, at least more of the liquid asset classes, are definitely higher. On inflation, as as I alluded earlier, these are supply side issues. So, we have oil, we have natural gas, which is leading the way. Then you have oil going up. Yes, shale couldn't kind of get in place in time because of COVID. So, as Sankara said, yes, it will be transient. There will be a time when shale will come back, and you will see all of these prices correct. But please understand, 12 to 18 months of supply side disruptions. Whether it's your milkman or whether it's your newspaper, to a cargo company, to a shipping liner. I mean, shipping liner container costs have gone almost fourfold, right? $4,000 to $16,000. So the point I'm trying to make is, we went into a world of JIT, just in time. Everything was working fine, and these disruptions now have taught us some lessons, and it'll take a while before we are able to correct that. But we will correct that. So what you're probably going to see, in my opinion, is inflation peak somewhere around next year, because it will take some time to get the whole supply chain in sync. And then 2023 is when the base effect kicks in, and as Sankara said, everything else comes in, and then the true inflation is truly transient then, and that's when you see a big fall in inflation. So to summarize the impact on the rest of the world or markets, one part is inflation is good. Actually, it kind of stimulates growth, but when you have inflation for so long, it shaves off growth on the longer part. So yes, I would say short term to mid term bullish, long term you're going to shave off a couple of points on growth. And just quickly to answer your question again on currencies, ideally tapering should allude to dollar strength. So there could be a small kickback on dollar strength, but eventually it would be dollar weakness, not too bullish on the dollar with the twin deficits and all of that, which basically means rupee will, on the shorter term, immediately have some depreciation. But over long term, I would say the depreciation should be fairly benign and in line with what RBI wants it to be.
Okay, since both of you have spoken about on what direction rupee could go on, is it too much to ask if there's a range that you're putting on for rupee for the next 6, 12, 18 months? Sankara, you want to go first on that?
Sure. I agree with Brijesh on that, right? So now, if you look at dollar, if you look at the Reuters polls, for example, most of them over a 1-year period are pointing out to the fact that dollar will weaken. For example, dollar will strengthen. I'm sorry. So, for example, euro dollar is expected to go up to 1.19 versus the current level of 1.16, and similarly for other currency pairs as well. Now, when I look at rupee, on the other hand, typically, ideally we would want rupee to remain strong, but on the other hand, we still coming out of a very, very long term challenges which we've had as an economy. I think a depreciating rupee would obviously support us from an exports perspective. We are expecting the current 2022 current account to be a deficit year, even though the balance of surplus is expected to be BOP is expected to be a surplus. So overall, I think I would expect rupee in the short term to remain stable or probably appreciate a bit, but over a period of 1 year, I would expect it to depreciate to 77.
Okay, 77. Is that your figure as well, Brijesh?
So, well, Sandra's the guy from Reuters, Refinitiv. So putting his levels out there is what he's supposed to do. I'm the banker to my customers, and the idea is to kind of help them navigate this. So, but let me take a shot at what you asked, and I think what I'll do is I'll try and go a little deeper into what Sankara. I think he covered the broad part well. So. So again, when we look at dollar rupee, you obviously, as Sankara correctly said, you have to look at the dollar first. So let's look at the DOLX or the dollar index. We've seen it range 93, 94. It's not been conclusively been able to break through on the higher side. There are some critical levels. If it does break through, then if it breaks through 94, 94.5, then you could see a very, very strong dollar run. But I think most of the market feels that it's right now running out of steam. It's a bit toppish here, and it might come off. Obviously, if you look at what's around the corner, which is tapering, which we've already spoken about, what is tapering effectively, right? I mean, effectively, there's going to be lesser dollars. So in a very commonsensical sort of way, you're going to see the dollar value go up because there's fewer dollars. So if that were the case, then there is a bout of dollar strength coming, which is where I kind of concur and agree with Sankara as well. Now, if the dollar strengthens, and let's now come to dollar rupee. So let's look at what's happening back home here. So Sankara spoke about, the BOP, the CAD. So last year we had a record BOP balance of payment, which is effectively, as you know, your net position was almost positive to the tune of about 85 billion. So let's just break that up a bit. So you have your trade deficit last year, which was about 102 billion. Which this year, incidentally, Manisha, is that I think for 6 months we're already at 80 billion. The last number that came in 73 for September was almost 23 billion, right? So I think we will definitely have, and with oil being where it is, you might have your trade deficit at possibly about 175 billion. Your invisibles and your receivables would probably be about, say, 150 billion, which basically means your last year CAD, which was plus 25 billion, this year is going to be minus 25 billion. So that's a 50 billion swing the other way. Capital accounts, yes, it's been a good story with the IPOs. But, in effect, I agree with Sankara that last year's 85 billion record BOP is not going to be met this year. So our net BOP would still be positive, probably in the 45-50 billion range, which basically kind of is trying to tell us that the rupee should depreciate, and which is why I think both of us are kind of on the same page that you will see a bit of depreciation. Now coming to specific levels, if you've been watching the central bank, I think they've done a pretty decent job about ensuring lower volatility. And I think what everyone's expecting is in this quarter, it's winter coming up. You're going to have more requirement for oil, natural gas. So the way oil's headed, there could be $100 shock coming, which could, you're already seeing a little outflow start up. So we probably have RBI defend rupee a bit and, kind of, not let rupee slide too much. So I would say, a range of 74.5 to 76.5. I wouldn't be surprised if we do touch a 76, in the next probably 5-6 months. But having said that, towards March, I think, Feb, March, things should kind of circle back and cycle back again. And, you could see something. So I don't want to put an exact number to this, but I would say any dip on rupee is a buy now from an importer's perspective. And I think we would see a higher number between, I think we should touch 76 and probably head higher as well.
The one good point, Mr. Panda, clearly has been the forex reserves increase, not just in US, in China, in Russia, as well as we have seen, but for the Indian markets as well. And how would you see the Indian rupee reacting to that?
See, the build-up of RBI's reserves is a positive for India, positive for exchange market as well. So why I say positive, as I said in my last question that you asked, is that we are much better prepared. So if you have more reserves, you are much better prepared for any emergencies that can come, including tapering that we were talking about. So it's a very big positive from exchange market side. And to the question that there are multiple venues, yes, multiple venues are there right now. There are NDF markets. There are markets which is operating outside India. There is onshore market, offshore market. So there are multiple venues which is operating, and liquidity in the market across all the multiple venues are, as I understand, are quite good. So I don't see that fragmentation of the market is of any concern at this point of time, because liquidity is there in all the venues across the markets.
Okay, fair enough. So, even as there were a lot of uncertainties and issues into the market, one statement that kept coming back and from various economists and market participants was, oh, but we have a good RBI forex reserve, and that has been a strong number. Sankara, have you seen that come in as an encouragement, as a cushion, and what kind of a support has the rupee been taken from that?
Yeah, I think we have to go back to the previous topic which we started with, right? So which was the tapered trend run, which happened in 2013. So if I remember correctly, I think rupee depreciated from, I think, around 54 levels all the way to about, 68 levels. And that was like a significant depreciation, which in just a short span of time. It was just about a 2-3 months period. And eventually, because RBI had a significant amount of reserves, we were able to stabilize, obviously, at around rupee stabilized by around 62, 63 levels. So such sharp movements is obviously not warranted for. I think that's always in the mind of in any regulator to keep the volatility in check, right? And especially around FX. So though there have been a lot of discussions around how do we use these FX reserves for investments, or should RBI be investing outside India in different instruments, there's been a lot of discussions around that. But on the other hand, especially when it comes to maintaining these reserves, we've gone from about 440 billion in October 2019 to we're at about 640 billion right now. So that's about a 45% increase over a period of 2 years. That's a significant accumulation of reserves, which again has happened because of all the surplus which Brijesh talked about on the balance of payment side as well, right? So now that gives a lot of arsenal for RBI in case, obviously, the taper starts again, obviously, from Fed perspective. So that's, I think, what the intent would be, and especially to stabilize rupee from as a central banker, that would be their key focus.
And how would you say that at HDFC on how you are using technology to overcome the challenges in the pricing and distribution of forex to your customers?
In SDFC Bank, we had actually started preparing for going towards digital very early. In fact, I was the one who had started it way back in 2012. And as I am speaking today, we are prepared to stream our prices, stream our prices to all the market participants. So we have the capability as of now across different channels, across multiple venues, including the venues like say 360T or other or Reuters, RET, so on and so forth. So we are prepared as and when a customer wants prices from us on multiple channels, we can give.
All right. The other thing that I want to jump on, and this one is to you, Brajesh, is about the impact of fragmentation of forex liquidity across multiple venues. How have you seen that? What is the longer term impact of that you see on the economy?
So obviously, the pandemic has kind of obviously pushed us onto a we have no choice. I think it's ushered in the digital wave much faster than we would have liked, and I think it's common across consumers or corporates. So I think given that we're already seeing, let me tell you, at a bank level, it was FX all first, and it was FX Go, and now 360, and we're seeing multiple platforms, and we're seeing a definitely a higher user base, and I think a broader acceptance. There was a time when even from a trading perspective, traders had to kind of keep all of these, update all of these levels. But I think more and more people are realizing that digital is going to be the way forward. I think this fragmentation will initially be call it a learning curve or whatever. But I think initially, while it might be a little uncomfortable, I think eventually it is this digital fragmentation which will eventually, like water finds its own level. All of these will kind of consolidate, or there will be a layer above or below which will consolidate all of these, and eventually this will only create and give us access to larger and more liquid pools of liquidity, which is eventually what the market wants.
So Brajesh, I mean, as you said, the world is changing really fast, and there's various kind of technologies coming in. And my next question is going to be blockchain, not this one. I will come to that. But as of now, as you said, the world is changing fast, and there is a consumer demand as well. Is the reason the regulators and the banks need to change too? And we have seen those come across as well. So when it comes to pricing, does that change? How has the distribution been? How has the feedback from ground been?
So I think it's time we in many ways, yes, you're asking the question about the elephant in the room, which a lot of people tend to dodge. So let me again step back and give let's just look back at what's been happening in the fintech or the blockchain or the digital world. So traditionally, you've seen fintechs come in and I wouldn't say encroach, but definitely enter the banking arena and the banking space. But you would notice, Manisha, that most of the fintechs tend to come in at the consumer side. So it's credit cards, it's payments, it's gateways, it's all of that. And honestly, they've been very, very successful. They have taught banks a trick or two. They've grown at paces that we can't imagine. And why is that? That is primarily because I think fundamentally a fintech is built around convenience, and a bank has been built around compliance. So we're two very different animals. And what's been happening is, 5 years ago, we saw fintechs really grow in on the consumer side. There was a time when, we were all worried, yes, what's going to happen? Fintechs going to become banks. But I think fintechs are much smarter than we probably give them credit for. They've realized that while banks, are big, there's also this whole compliance angle. And I don't think too many fintechs want to be banks, right? So we're today in the next phase. And like I said, COVID's going to push that faster or nudged us towards it closer. But the broader point is what was happening today in the periphery, which was the consumer part or the retail part, has now moved into the core banking. So we're talking trade, we're talking forex, we're talking trading, we're talking corporate banking, we're talking LCs, BGs. So we have a host of fintechs now who are really beginning to crack the code. And since, like I said, they're all built around convenience, and with the valuations, they're getting the right money to spend as well and the right ideas. I think it's been a great story.
Another important point clearly comes in on the preparedness of the Libor transition. How prepared as a bank are you? Are there any clear ARR solution emerging from the banks and corporates?
See, this challenge is like, I was saying the other day, it is like Y2K challenge that the entire world faced earlier. So the changeover from Libor is almost like akin to that. However, the authorities across the globe, including all the central banks, have come together, and now things are much clearer how it will happen and to what it will go as ultimate destination. So from bank's perspective, we are ready because we have been engaging with this for last maybe 7-8 months, and we are ready with the changeover from the system perspective. We are also ready with changeover from other technology perspective, and we have committed to the central banks timelines by which we can completely change over from Libor to other ARR. So in terms of ARR, we see that there is a lot of acceptability to SOFR in terms of dollar. So we are most probably going to move towards that. That journey has been slow, but it has been steady. And I think once it emerges as the winner, as we say, we will be ready to kind of embrace it into our fold. So we have already done a signature deal with another bank on the interbank side. We are ready. We are already started quoting to our customers. So from that perspective, we are ready.
Sankara, let me bring that question to you in a different way now. So while, of course, we are talking about operational efficiency, transaction costs going down, and as Rajesh mentioned, a marriage of sorts of convenience between fintech and the banks here also. I also want to stretch this question to blockchain as a technology, safety, security, efficiency. How are you looking at the overall currencies, cryptocurrencies as a market going forward?
Thank you, Manisha. I think I really like what Brijesh said, right? It was beautifully summarized in 2 words. It was convenience and compliance, right? So it's banks, mammoths versus startups who are trying to do more convenient way of banking or convenient way of transacting in any shape and form through maybe apps, accessibility through apps, web portals, and so on and so forth, right? So they're trying to bring that in. Now, it wouldn't matter whether it's crypto, whether it's blockchain. At the end of the day, the consumer, on one hand, should have the ability to do that particular transaction conveniently. It might be trade finance, it might be for a corporate, it might be a FX conversion for a retail consumer. Irrespective of whatever the case is, at the end of the day, it's convenience that matters to the end user. Now, with the pandemic, obviously, a lot of things have become more and more digital, and the emphasis has been by a lot of companies that you kind of look at it from a digital perspective. It can be saying, okay, fine, I want to do it via web or via mobile devices, depending upon wherever the compliance allows them to do so, right? So that's the thought process. Now, how are we achieving it? Like I say, I mean, like Brijesh also pointed out, right? So some of these fintechs are quite nimble in the way they can operate. They could turn around products and solutions in such a quick fashion, which traditional banks and traditional companies are at times a bit challenged to do so, because obviously they're not, because the resources don't exist, but because the cost doesn't justify the revenue, right? So this is typically how you would look at it. These disruptions, I think, will lead to a lot more partnerships. I think it might be between technology players like Refinitiv with let's say a startup who does a lot of corporate treasury or a treasury management system who supports corporate treasury in trade finance. We're also seeing technology disruptions in supply chain, where we are the fintechs are actually helping improve the DSOs for corporate treasury. So that's phenomenal. I mean, it's and added on top of it globally, there are even these investors who are more buy side in nature, or even HNIs in nature, are happy to fund into some of the buyer-led financing models. So the technology disruptions are happening in different shapes and forms. Eventually, what I also agree is that there will be a lot of partnerships with fintechs, and that will lead to growth across both the fintechs as well as, and the eventual winner would obviously be the consumer.
Just you want to add to that? I mean, as Sankara said, you really put it quite well when you said convenience and compliance, and Sankara has just about added so much to that. But I also want your sense also when we talk about blockchain and etc. I mean, that's yet another technology which we're still talking in hush-hush tones, but what's your sense on how world could really change with that advent as well?
So in terms, sorry, was this question? Yeah, go ahead, Rajesh. I'm sorry.
Just to add on to what Sankara said. So one is obviously we have to look at them both differently, and I think we all understand that blockchain is in many ways is the backbone of everything that we're talking about. So let's look at blockchain. Yes, it's I think an amazingly adept, simple, and transparent work that you realize it's public ledger and everyone can check everything. Now, what you build on to that is something that we can discuss. So blockchains obviously it can be used in I can think of so many different places, obviously, and the world's obviously experimenting with all of that. And I think blockchains already exploded. India is just is slightly behind the curve on that, and I'll come back to blockchain. But before that, again, to talk about the cryptos. So let's be honest here. I think when Bitcoin came up, it was all about Bitcoin. It moved up so fast, and now people are realizing there's some flaws. So now it's Ether. So I think central banks are being, I would say, very smart, or in a good sense about it, because finally central banks have it's their duty and responsibility to protect all the investors and all the consumers. So today, until you don't have the right rules, the right regulations, the right compliance, so while it sounds all stodgy and boring, but the fact is today, you'll always hear your friend on the street telling you, I put so much money in cryptos, it went up. But the point is, would you go and leave all your money in cryptos today? No, it's not fully kosher yet in that sense, right? So until I think we have proper guidance globally on this, there is a regulatory risk on that. And like I said, I think the world has to decide. But blockchain, something else, Manisha, that is something that the world has kind of embraced and accepted. It is good technology. It is technology that is transparent. And look at the generations moving forward. I mean, I don't see, in the current generation, people go out physically. And like I said, now we're all digital. We're having this call digitally. The new generation is spending more and more time in the metaverse, and the blockchain is what is helping them create objects. I mean, NFTs is the next big thing. I mean, it's today happening only in art. Tomorrow it could happen in 40 other places. You'd have your child go on the metaverse and buy a digital t-shirt for a digital avatar, and probably go have coffee in Starbucks. So all of this is going to need some spending, right, as well. And what do you spend? Unfortunately, right now, the dollar, the rupee doesn't work there. So yes, it's something that still needs to be solved. Unfortunately, it's moved so fast. But I'm hoping that the regulators of the world come together and come together and concur on what is the right way to move forward on that. And yes, for now, it's a different asset class that a lot of people are putting their money into.
The another big market that's coming in is clearly the gift city. What is your sense on the impact, the operations, the NDF trading on Indian rupee from that?
See, gift city operation NDF trading was allowed by RBI some time back, and I think we were one of the first banks to start trading in that asset class, for example, in NDF. As of today, I can say that we are one of the market makers from gift city in the NDF market, and our volumes have been pretty decent in that sense. So it has been an important development from the perspective of giving a level playing field to the Indian banks, which was not earlier available to any Indian banks. So this is something which will go a long way in taking out the inequalities between the offshore and onshore market, and enable Indian banks to participate in this market, to give give liquidity in this market, and probably in days or months going forward, you will see there will be no difference between, say, NDF as well as onshore market. So most probably we will see that happening in coming months. But as of today, because of the freeing up and because of the presence in gift city, we have been able to participate from the day one itself.
Mr. Panda, would you expect the volatility in the Indian rupee to just about continue? What is your sense on the road ahead and technology's role in improving the forex workflows here?
See, for the Indian rupee, we had always had this problem of deficit, as well as higher fiscal deficit, as well as the current account deficit. In a sense that current account deficit actually has changed for the better, because in the last 1 year or so, our imports have come down, and the capital flows have been very, very robust. So therefore, in fact, current account has gone into surplus and may remain surplus for some time because of the robust capital flows. So in that sense, it has improved. So, but does it mean that rupee will appreciate from here onwards? I doubt, because as a construct, since our inflation, our interest rates, as well as all those current account deficit, so on and so forth, will remain a challenge. So rupee will probably depreciate a bit from here, what is being traded today. But I don't see too much depreciation from here as well, because we are already trading at 74.80 against a dollar, and near-term depreciation will be probably 1% or so. I don't see it going beyond that. However, we need to be aware that oil has moved almost more than 20%, and if oil prices remain elevated, and if the growth is going to come back to Indian economy, obviously our import bill is going to go up, and obviously that is going to affect USD INR exchange rate. But a lot of this has already been, already come into the price that we are dealing today. So that's the reason I say that rupee depreciation is possible, but not to the extent that people might be thinking that there will be a runway depreciation. No, the answer will be no to that.
All right. I was really laughing my gut out on digital, me buying a digital shirt and drinking a digital coffee. I mean, yeah, that
It's
would be
true.
something.
It's happening. It's happening. It's already happening.
All right, let's come back to physical then. I want to jump topics here and talk about Gift City as well, because the forex watchers are looking at this also with a lot of interest. Sankara, to you first. Then, what's the sense that you get of the Gift City operations that we could see in the forex markets?
Yeah, so I think first and foremost, one of the key aspects of Gift City, I think at the core of it, we are moving towards capital account convertibility, right? So there's a lot of steps we need to take to reach that point. There's been a lot of discussions, a lot of papers which RBI has put up around how do we get there, and I think Gift City is one of the stepping stones towards that. I think one of the first steps which we have taken is allowing NDF trading out there. What I understand from bankers, obviously, Brijesh probably would be in a better place to answer that question. I think volumes have shot up dramatically in the last 1 year. And it's gone about billions of dollars in a month. So I think, so having said that, that is also leading to less and less arbitrage between onshore versus offshore, which was one of the key intents of RBI to stabilize, the differences between onshore and offshore trading, and that will then lead to lesser volatility between Indian rupee versus, what NDF trades at post-market hours, right? So now that being achieved, and hopefully we'll be in a much better place as we go forward with volumes increasing. There'll be more and more steps towards capital account convertibility, and I think getting investors from outside India and to look at Gift City as the venue, there's a lot of steps already being taken, right? So now you're seeing more and more asset management companies, alternative investment funds being set up in a GIFT to attract some of the offshore investors to GIFT. That will also mean that a lot of capital is being deployed in India, I mean, in the sense towards its GIFT, and that will lead to a more transparency for RBI as well towards achieving the capital account convertibility. I think that's my take on what the end objective would be for GIFT.
Rajesh, why don't you also comment on that? So when we talk about the NDF trading, and as Sankara said, that the volumes have been jumping up, and there's a lot of positives that we could see come out of there. Borrowing, lending, do you see all of that onboarding as well?
So once again, we've had a very, I would say, proactive central bank. With if any one of our were on in the central bank, I mean, imagine every morning, you wake up and you see dollar rupee being pulled in a different direction sometimes. And, it's best that we have some kind of control over that. And I think getting Indian banks to access, the NDF market was a great decision. And Sankara was absolutely right. Then within a week, most of the arbitrage had disappeared. On average, you'll have about 3-5 paisa, arbitrage between those the two markets now. So they're pretty much aligned, I would say. This kind of speculation where you have NDFs leading the rupee is all gone, because everyone, a lot of banks have now access to it. From a liquidity perspective, yes, I mean, the NDFs, to be fair, were always a large market, because as you know, it's not only India, it's everyone outside India who's playing that market. So so the volumes have definitely grown, but they're sizable. So today, I think now that we've the central bank has managed to ensure the arbitrage has kind of come off considerably. The next stage would be to make Gift City, one of the centers of pools of liquidity. Today, it is London that dominates it, probably followed by Singapore and then Middle East, and maybe then I would say we have GIFT. So I think it's important, and I think from all of our perspective, all of us bankers are adding to that. The number of banks that are coming into Gift City is great. You have Indian banks opening up, foreign banks opening up, and I think I would say in a couple of years you definitely see the story build up very fast. And I do hope that the liquidity pools come closer to Gift City, come closer to India than lie in an offshore location. So that's point number two. I think one of the things that we could do better is, it's one thing, just opening the market. Now, who's accessing the market, right? So you have Indian corporates who are investing outside and who want to hedge, could definitely use NDF. But the bigger use is, a non-Indian entity which is wanting to enter Indian markets, but maybe has its treasury offshore and trading the NDFs. We have to woo them. So one is we definitely have Gift City, which is great. But I think, ease of doing business is also very important, whether it's the rules, regulation, documentation, what we ask of them. We need to bring that at par. So pricing is one part, which, the arbitrage is kind of knocked off already, or mostly done with. So I think the ease of doing business, documentation, I think if we can ease that up a bit, it will definitely, attract a lot more capital. And as Sankara said, really grow that business. But otherwise, yes, pretty bullish on Gift City. In fact, if I'm not mistaken, Axis is one of the banks with the largest footprint on the ground in Gift City, and we are really keen to ramp that business up.
All right, gentlemen, that has been a very interesting conversation. But before we let you go, I do want one final word from both of you in sense on what is your sense on the technology's role in improving the forex workflows. Sankara, why don't you go first?
So I break it into three parts, right? First is price aggregation, and that's happening because of fragmentation of liquidity. Now, there are various different venues. Every venue has its own, positives and negatives. There are anonymous venues which allow firm prices. Then, obviously, you have disclosed venues where specific counterparties are quoting you. Irrespective of whatever the case is, at the end of the day, you want the best price across all of these venues to be taken up. And that will lead to a lot of price aggregation. And it just doesn't matter that we are just aggregating the prices. At the end of the day, if the trader is not able to hit those prices, then it doesn't help him or her. So the way the aggregation will happen eventually is it will be multiple venues getting connected using technology, and hedging or transactions or trading or whatever you want to call it will be happening automatically or through traders to these venues. What would that lead to? That will also lead to reduced transaction cost, not just for banks, also for customers of banks, corporates. What we know as multi-bank platforms like FXall today will further and further evolve into aggregation softwares, which will allow some of these technologies to be used by not just by banks, also by corporates as well. And that will also support a lot of price. I mean, they'll basically get the best price across all of these venues, right? So that will lead to a lot of competition, and hence, whoever the taker is, they would then get the best price across these venues. Now, what does it do in terms of operational efficiency? This will again lead to, if I look at it today, let's say you have 4 or 5 different venues where a bank is trading or a corporate is trading. You would need to have the infrastructure connecting to these venues. You would need to have the infrastructure to do processing of these trades. STP is what we call it, and then further appropriately process settlements as well. But when we unify all of this using technology, there'll be significant operational efficiency for the bank, the mid office, as well as the back office, and eventually it'll lead to a better price discovery as well.
Rajesh, your sense on, again, the technology's role when we look at the forex flows going forward?
So, Shankara mentioned about FXall. I remember a decade ago when, it went live, there were not, it sounded intuitively the right thing to do, but it's taken a while before markets accepted it. And right now, you have so many players on it, and it's been a very good success story. And there's a lot of build up on others on similar platforms. So I think Manisha, the challenge is everyone knows going to the gym and eating the right food and exercising or not eating junk food. This is what we all know, right? But somehow we don't land up doing it, and that is the similar problem that we're facing in this space. So we know going digital is great. It's good for all of us. I think everyone's done their bit. Companies like Refinitiv have come out with amazing tools. You have banks trying to revamp their systems. You have corporates trying to connect with banks and say, let's connect our APIs, let's talk digitally. You have the central bank coming out with platforms. So I think things like COVID have obviously helped nudged us a lot more into that. But I think somewhere it's just the whole human condition of not leaving the old and embracing the new. So I think the more we make it a slippery slope, it would help. So yeah, to kind of summarize what I'm trying to say, I think we're all doing the right things. For example, banks most banks today are again investing a lot digitally. We're seeing the corporate treasuries actually revamp themselves and again move to as much of a digital platform. You have fintechs also attacking the same space, and the central bank doing their bit. So I think it's only a matter of time before the world gets that much more digital in the FX space. And I think the next bit will be then adding more product suites onto it. Till now we're only discussing FX, but I think it's a matter of time before options, cross currency swap, everything move online digitally.
All right, we'll look for that. And this really is a longish debate. But thank you so much, gentlemen, for joining us here today. It has been an interesting, exciting conversation with both of you. Thank you so much for your time. We appreciate it.
Thanks for having us. Bye, Manisha.
Yeah.
Bye, Shankar.
Thank you, Nisha. Thank you for having us. Bye.
Thank you very much.